clearly they save the best to last. So I'm here to talk about small companies and why cash flow is critical for small cap investing. Now, most of you will know these two investors. Obviously, Warren Buffett's very famous, and he's championed the fact that cash flow, or DCFs, are a very good way to value companies or value businesses and assets. And some of you also know a guy called Seth Klarman, who founded a hedge fund called Baupost, which has been another very successful long-term investor. And he basically points out that cash flow is critical for separating investments from speculation. And I think that's how we think about when we're using cash flow. But cash flow is not just important for valuing companies. Investors use cash flow to determine the relative values between bonds and equities and property and other asset classes. But it's particularly important for small companies. Now, why is that? It's basically, we use cash or cash flow for a number of reasons in small companies. Now, firstly, we want to control risk. We're in a small part of the market where things are more volatile, companies are smaller, risk effectively are actually elevated. So companies without cash flow can get into real trouble, and they have a very hard time digging themselves out of it. So consider, if you like, Slater & Gordon. It's an example that Sean Martin raised before. Slater & Gordon took on a lot of gearing to buy an asset in the UK. It then had 2 or 3 profit warnings in rapid succession. And as a result of that, the share price collapsed very quickly. And there was no way it could raise enough capital with the share price being diminished to pay off the debt. So that company went almost into liquidation. Capital markets invariably tighten. And if capital markets fall, investors are skittish. They're very reluctant to invest more money into businesses that are going through a tough time. And banks also have their own credit cycle and will sort of wax and wane in terms of whether or not they give people money. So we don't want to be involved in companies that rely on these sort of external factors in order to raise money or stay in business. In addition to those things, it helps us avoid fad investing. We are very keen to make sure we can compare between different stocks in our space and different universes. I mean, analysts are very clever. They're also very good at finding out ways of valuing things. So Tim mentioned eyeballs before. Back in the dot-com boom, price to eyeballs and number of clicks, etc., was a very popular way of measuring and valuing companies. But it's not very effective at actually comparing between sectors. And so we bring everything back to cash flow to actually get a very good way of comparing between sectors and stocks. We also work in a universe that's very large. Small companies and microcaps are over 2,000 shares in the Australian stock market. How do we get around that many shares to shrink back to a universe that's kind of measurable? If we screen out stocks that don't make any cash flow, for example, in microcaps, we reduce it from 2,000 down to about 600 stocks. So it's about 2/3 smaller universe if we just screen out the ones that don't make any money. And then finally, it's simple. It's a simple process we can understand, explain, and follow. And if you haven't got cash flow, you'll see some of these very famous shares on the right-hand side there that have lacked cash flow historically. And during tough times, they dissolve and they become uninvestable. Now, my first example here is a stock called Mesoblast. Now, I'm not picking on Mesoblast per se. It's a medical company that does research into stem cells and trying to find uses for stem cell cures. This chart here is one we produce on every stock we model. And what it's doing here is comparing the free cash flow before tax and interest, which is the red bar, against the accounting earnings, which is the EBITDA, which is the yellow bar. And you can see that over the last 5, in fact, over the last 10 years, that has produced negative free cash flow, negative earnings every year for the last 10. Now, to show I'm not being biased here, the stock's actually been one of the best performing stocks in the small cap space over the last 12 months. It's performed very, very well based on some good news flow, etc. But we'd argue that kind of stock, unless it can ultimately make cash flow, is very hard to value and very hard to invest in. And every single year for the last 10, it's had to raise money. It's gone back to investors and place capital. And so the share count has grown at 14% compound. It's raised money every single year, and it's a very challenging place for us to be investing capital. A guy called Al Rappaport reminds us investors that profit is opinion and cash is fact. And to that end, this next stock example is a little bit fishy. It's TasSal, which is a Tasmanian salmon producer. And you can see again that chart that I highlighted before shows the historical earnings and the historical cash flow. And the light blue numbers show, well, the light blue chart there shows you the earnings, and that's basically been positive every year for the last decade or so. But the dark blue numbers, the dark blue bars are the cash flow. And they've been consistently negative over the cycle of the business. Why is that? It invests very heavily in new pens, in new livestock called smolt, which is small fish. And the accounting earnings include a term called skagara, which is effectively the growth in the value of your livestock every year, and they can actually bank that to an accounting earnings. But try and take Skagara down to your bank and repay debt and see how they take that. Now, just to show you, we're not just about negatively screening, we're also about positively screening using cash flow. Over the last 12 months, this is the relative performance of large, small, and micro caps, and you can see micro caps have been a pretty bad form relative to large caps. There's been a number of reasons for that. There's been a challenging consumer environment to be trading in. You've seen Amazon fear factor coming down here, so everyone knows that Amazon's coming to Australia. It's been in the paper about 4,000 times. And so everyone's run for the hills, and there's been rotation back into large and small companies. Larger companies out of smaller micros. So we've gone through and looked at the worst performing 25 stocks over the last year and run our filter of cash flow and good balance sheets and valuations across that. And you'll see the 3 green bars in that list there are names we've picked out of that 25 universe to actually add to portfolios. And they include a few retailers, they include a healthcare company, and they include a company called Accenture. So using the same analysis I said to you before earlier, every single stock we model, we basically produce these free cash flow graphs, and they give us a sense of where the company is generating cash flow. So Accenture, having performed very, very poorly, we ran through the models, and look at what turns up. Great cash flow conversion. And it's quite an interesting story because, I don't know if you guys know what Accenture does, but it's the leading media monitoring business in Australia. And that means if you're interested in terminology, if you're a brand company, or even if you're the Prime Minister's department and you want to track certain terms that are being mentioned in the media, you pay Accenture a fee, and what they do is they track not just the online world, they track the offline world, so all the papers, the regional papers, regional newspapers, they track TV stations, radio stations, everything basically. And every time there's a mention of your brand or your word, they report that and send it back to you so you can track what's going on. Now, a year or two ago, they did an acquisition that was fairly poorly timed. The stock market didn't like it, it didn't make the earnings forecast to make, so the stock price fell. Plus, a competitor called Meltwater, which has been in Australia for a long time, was actually aggressively discounting and taking away market share from Accenture at the bottom end. Now, Accenture, we thought would respond to that by launching their own product, which they've done. And in fact, as it turns out, the leading competitor was actually had an account open with Accenture and was kind of filtering information out of Accenture and reselling it back to their peers. So a whole bunch of those one-off factors led the stock to kind of re-rate. So we bought that stock at 7 to 8 times EBIT. As I said, had great cash generation, very good valuation, and been knocked out by the marketplace on a couple of fears we thought were sort of one-off. Another good example of cash flow in action is a company called Vita Group. This was the old Phone Zone, which became the T-Life stores, and what these guys do is they resell handsets for Telstra. Now, on the top chart there, you can see that it's a very busy chart, but the top left there shows you the historical cash conversion of the company, which has been excellent. So on the face of it, you go, great, big tick, buy that share. Digging down though, you'll see that the bottom chart there shows you the margins of that company over time. And you can see that historically they were very high, they're almost 9%. They've dipped down to as low as 2 or 3%, and then they've recovered again back to 7%. So what do you do with that? You've got cash flow, which converts, which looks really good, but then again, you've got a history of volatile earnings. So how do you value that? Well, we typically take an average of those margins and say, okay, well, we know this business is cyclical. It goes through periods of, debating who should have more earnings between itself and Telstra, and we value it on that basis. So a year or two ago, when stock was capitalising margins of 8 to 9%, we thought it was very expensive, and we sold that stock out of the funds. Fast forward a couple of years, and Telstra and Vita Group having a bit of a tussle about who control the margins. Telstra needs more money now because it's got some pressure on its earnings. It's gone back to all its retailers and said, we'd like to take some margin back. So Vita Group has come under a lot of pressure, and as stock got down to a low of about $1 or so, we started buying that for the funds because we thought it was very attractive on a long-term basis. And these two, just quickly on the right-hand side, you see these other charts here. We go through a bunch of other things looking for risk control and valuation. You can see that we do portfolio force analysis, and on that basis, it doesn't score particularly well because it's very reliant on Telstra. So just to wrap up, we see the shift between growth and value continuing probably towards the value end in the small cap space. The kind of stocks we're looking for in our portfolio, which have good cash flows, low gearing, and pretty attractive valuations, are also the kind of stocks that many venture capital firms and many foreign firms are looking to acquire. So small cap is where many M&A activities take place, and we think that trend is likely to continue. And we see the washout from the Amazon sort of scare factor and resources which haven't completely recovered as being, those two areas are pretty ripe for future investments as well. So yeah, free cash flow, balance sheets, valuation remain our bedrock, and we think that'll be a good place to invest for the long term. And that's a quick summary of the returns that the funds have generated.